Hello, my name is Byrd, and I am a Financial Planning Associate here at Pathfinder Wealth Consulting. If this is your first introduction to me, I look forward to the chance to meet you in person sometime soon. I interned with the Pathfinder team for about a year before transitioning to a full-time status in May after my graduation from UNCW with a degree in finance. Given my recent graduation, I thought it was appropriate for me to tackle a topic which is top of mind for many college students and their families: 529 plans and financial aid. Let's dive in. It's no secret that college is expensive. On average, tuition tends to increase by 8% per year, which means the cost of college doubles every 9 years. If you're worried about the rising costs of education, a 529 plan can be a powerful college savings tool when you understand how to take full advantage of them. Today, we'll discuss some of those strategies. On a basic level, 529 plans are tax-advantaged college savings plans sponsored by a state or a state agency. There are two types of 529 plans: prepaid tuition plans and savings plans. A prepaid tuition plan is available for in-state residents and allows you to lock in current tuition rates by paying today for education at some point in the future. Essentially, prepaid 529 plans protect you against any future inflation in the cost of education. Unfortunately, prepaid tuition plans are only available in 9 states, and North Carolina is not one of them. You must live in one of those states to participate in the prepaid plan, and the beneficiary must attend school in that state as well. The second and more popular type of 529 plan is the 529 savings plan. Saving plans are tax-advantaged investment vehicles designed to help pay for education costs. The savings can be used at most accredited universities in the United States or abroad. Typically, a state partners with an investment firm to administer their plan, so you don't have to be a resident of that state to open a 529 plan with them. In other words, you can use a 529 plan from any state to pay for college in any state as long as it is an accredited university. Some states offer tax benefits for contributing to a 529 plan, and other states don't. Some states also limit tax benefits to in-state plans, while other states offer tax benefits for contributions regardless of which state's plan you use. In North Carolina, contributions to a 529 plan must be after-tax dollars, which means they cannot be deducted from your taxable income. However, any growth on those dollars is tax-deferred, and withdrawals from the plan are tax-free at the state and federal level if used for qualified educational expenses. At Pathfinder, we help our clients evaluate costs, investment options, tax benefits, and more to determine which state's 529 plan is best for their needs. Qualified expenses include tuition, fees, books, costs associated with certified apprenticeship programs, and more. A list of the qualified expenses is shown here. Note that you may be able to use the funds for K-12 education. Not all states recognize these provisions, but it may be an option for your family. The primary parties involved in a 529 plan are the participant and the beneficiary. The participant is the account owner who will make donations to the plan, and the beneficiary is the future student. Any tax-paying citizen 18 years or older can open a 529 plan as a participant, even if you aren't related to the beneficiary. In fact, you could even start a 529 plan for yourself and be both the participant donor and the student beneficiary. If you are the participant on a 529 plan, you should also name a successor participant, which is a person who will manage the account for the beneficiary in the event of your death, allowing the future student to continue reaping the rewards of your hard-earned savings. The participant of a 529 plan never loses control of how or when the funds will be used, even once their beneficiary turns the age of majority. It should also be noted that while the participant is the account owner, contributions to the 529 plan can be made by anyone. A company called UGift took advantage of this rule and created a unique, simple process for friends and family members to make online contributions to a 529 plan as a way to celebrate special occasions like holidays or the beneficiary's birthday. When timed appropriately, contributions and withdrawals can help maximize your 529 plan. An important note for contributions is that you can only contribute cash to a 529 plan. You can't contribute stocks, bonds, or mutual funds without liquidating them first. Secondly, when you donate to a 529 plan, it is considered a gift under federal tax law. The annual gift tax exclusion for 2021 is $15,000 per donor per recipient. However, under unique tax law for 529 plans, a donor can contribute up to 5 times the gift tax exclusion in a single year. For 2021, that would be $75,000. and avoid paying federal gift tax by averaging out the gift in equal amounts over the next 5 years. In addition to the gift tax considerations, North Carolina also limits the total contribution amount for a 529 account to $450,000, which represents the total cost of 4 undergraduate years plus 3 graduate years at the most expensive school in the state. While a lump sum donation to a 529 plan gives your money the longest time to grow, it may not be a viable option for everyone. North Carolina 529 plans allow you to set up regularly scheduled contributions to the account, which can come from your bank account and in some cases be deducted directly from your payroll. Again, these deductions would be after-tax dollars, so there's no tax benefit, but it's a great way to automate your contributions to the plan. When you open a 529 plan, you'll have 2 basic ways to invest the funds for your beneficiary. The first is called the age-based option. As the name suggests, the donations will be invested according to the beneficiary's age. As the beneficiary grows up and gets closer to college age, the portfolio's asset allocation will automatically shift to a more conservative mix of assets, similar to a target date retirement fund that many employers offer in today's 401k plans. The second and more hands-on approach is called the individual option. The individual option allows a donor to design and manage their own investment strategy in a customized portfolio. At Pathfinder, we help our clients determine the proper investment allocation and strategy so they can maximize the growth of their savings in the 529 plan. When it comes to withdrawals, there are a few important things to consider in order to maximize the benefit of your 529 plan. For one, withdrawals should be coordinated with education tax credits that you might claim, like the American Opportunity Credit and the Lifetime Learning Credit. Tuition expenses used to qualify for a credit cannot be the same tuition expenses paid with tax-free 529 funds. Additionally, a common concern we see with clients considering opening a 529 plan for a young child is the risk that that child won't attend college or won't need all of the funds in the plan. Fortunately, a donor can change the plan's beneficiary once per year to a family member of the original beneficiary without consequence. This could be a sibling or a cousin. If your beneficiary receives a scholarship, you are eligible to withdraw the value of the scholarship from the 529 plan without penalty, but capital gains taxes will apply. Now let's talk a little bit about how 529 plans can affect financial aid. When applying for financial aid, a student completes the free application for federal student aid, commonly called FAFSA. Colleges will use this application to evaluate the income and assets of a student and their family to calculate the expected family contribution, or EFC, which is how much the student will have to pay for school before receiving financial aid. The current formula for calculating EFC is 20% of the student's assets, 50% of the student's available income, 5.6% of the parent's assets, and somewhere between 22 and 47% of the parent's available income, depending on their situation. It is important to understand this equation so you can structure a 529 plan in a way that maximizes your beneficiary's future options for financial aid. Currently, the value of any parent-owned 529 plan must be listed as a parent asset on the EFC, which means 5.64% of the account value will be applied against the federal aid available to the student. In contrast, if the 529 plan were owned by the student themselves, the federal aid available to that student would be reduced by 20% of the account value. 529 plans owned by a grandparent of the beneficiary have some unique and powerful advantages. If a 529 plan is owned by a grandparent or any other non-parent individual, the 529 plan does not need to be listed as an asset on the FAFSA EFC calculation. Under current FAFSA rules, any withdrawals from a grandparent-owned 529 plan are counted as income to the student on the EFC calculation, which means that 50% of the withdrawal would be applied against the student's financial aid eligibility. However, a FAFSA rule change that is set to take effect on October 1st of 2022 will change that, and the student will no longer be required to report distributions from a grandparent-owned 529 plan as income. Although this change won't take effect until next year, income and assets on the FAFSA are reported on a basis of 2 years prior, which means grandparents can start taking advantage of this rule change in 2021. 529 plans are a powerful vehicle for helping your family, friends, and loved ones pay for college down the road. It's the gift that keeps on giving and is sure to make a lasting impact on the beneficiary's life. Despite this, it is important to remember that you can borrow for college, but you cannot borrow for your retirement. So before setting up a 529 plan for a loved one's future, ensure you aren't jeopardizing your own future in the process. If you would like to discuss 529 plans or other options for saving for future education expenses, please give us a call. Our contact information is listed here. We look forward to hearing from you soon. Thank you.